Welcome to a special edition of Crypto Corner with Investor Ideas. Today I'm talking to Dave Weisberger, CEO of CoinRoutes. He has over 30 years of experience in quantitative trading and started CoinRoutes with his son Ian in 2017 after identifying the fragmented markets in crypto. Ian's idea to build a software platform to help crypto traders navigate the markets and Dave's experience building algorithmic platforms landed them Bitcoin Suisse as their first client and one of their investors. Today, CoinRoutes supports trading for over 3,600 spot and derivative instruments across 60 major exchanges and liquidity providers. In this podcast, we talk about CoinRoutes and how to join the waitlist, proof of concept of Bitcoin, lessons to be learned from the year that was 2022, what regulations that could help the industry moving forward, and best practices as a crypto investor. To find out more about CoinRoutes or to reach out to Dave and his team, you can go to coinroutes.com or follow them on Twitter, YouTube, and LinkedIn at CoinRoutes. So Dave, thank you so much for joining us on the show today. For our listeners who might not know your background, can you give us the quick history of how you got into the industry and a little bit about CoinRoutes?
Sure. So I've been in the business of automating trading for a very, very long time. I actually started my career back in the 80s, if you could believe it, at Morgan Stanley, where I was in their technology department, and I was the guy who built the first program trading system on Wall Street. And I stayed on the tech side until like at the end of the 80s into 1990. To tell you the truth, as a technologist, I'm a pretty good business person. is probably the interesting thing. And at the end of that, I moved into the front office in portfolio trading. I did proprietary trading as well as trading on behalf of customers. I moved in the mid-90s to a company called Salomon Brothers, where I started their global program desk. In Salomon Brothers, we did a lot of quantitative things, and I got very involved with quantitative finance. I ended up being, as time went on, the chief architect of their market making and ultimately ended up running electronic market making and statistical arbitrage. And that takes me into the 2000s. Along the way, it became Citigroup. The last thing I did at Salomon, Citigroup became Citigroup. I ran a company called Lava Trading, which was the first real smart order routing algorithmic trading company in equities that had started about 10 years before that, give or take. And I was running that for the last year and a half that I was at Citigroup. And I got to meet a bunch of people, got very involved in that business. When Citigroup had its difficulties at the financial crisis, I left and the next year joined Two Sigma, which is another quant firm, and I ran Two Sigma Securities once again to run market making out of Two Sigma Securities and ran that business for a while. I left there and went to a software company during my non-compete year and then found myself as global head of market microstructure or equity market structure for IHS Markit. And to be honest, I didn't want to be in a big software company at that point. And around the same time that I organized a exit on favorable terms, my son, Ian Weisberger, came to me and said, hey, anyone who knows anything about market structure, there's this market called crypto, and they trade things like Bitcoin and Ethereum, and it's all electronic, but the markets are really fragmented, and I could really use someone to help me figure out how to build something to help people navigate those markets. So that was early 2017. And very shortly, we dug in. I started looking, and at the time, I knew nothing about crypto. And CoinRoutes was born that year. We filed our first set of patents toward the end of that year. Frankly, it was just our main patent for distributed smart order router was just granted by the USPTO this week. So kind of amusing. That was from early 2000. Yeah, so it gives you an idea of how long those things could go back and forth. But we started in crypto and we've been focused on it ever since. So we're coming up on our 6-year anniversary of the company, and we've been growing ever since. Now we are, a company of like 30 some odd people, and we processed over $100 billion of trades through our platform. And our entire goal is to get our clients better execution results, to be able to buy lower, sell higher, do spreads between different assets, etc. We see and are connected to most of the important exchanges and market makers in the market, and we kind of generally look at our role as helping to make the market more professional.
Love the family company as well. Obviously, you guys saw a gap in the industry at that time. Do you still feel that there's the same gap now? And what do you see that's changed the most, or is there a new focus for CoinRoutes?
I mean, I think there's a couple things. Let me unpack that question. First, with credit where credit is due, Ian saw the gap, and then I helped to help close the gap. And yes, things have changed. In 2018, when we had our first commercial product, nobody wanted to talk to us. They're like, "Oh, Bitcoin's going to the moon. Everything's going to the moon. Lambos and to the moon, and this, that, and the other thing." And in early 18, right before things started to collapse, everyone said, "Best execution? What do I care? So I pay a few extra dollars." I actually wrote an article describing why those few basis points of performance actually mattered more, but people didn't want to hear it. It was a harder sell. Agents, people who traded on behalf of others, brokers and stuff, basically told us to go to hell. Why? Because they said that they would make less money if their customers got a better deal because they couldn't take as much of a spread or they couldn't collect as much payment from their market makers. So it was a different world. That we don't hear that anymore. And so that's kind of a good thing. So to some degree, the market has changed. Certainly it's maturing. Certainly more people care about being able to buy or sell efficiently, but a ruthless bear market will do that to you. It started in 2018. People started to care, but once you went into bull mode again, all of a sudden people didn't. So it definitely creates people's need to sharpen their pencils. The other major thing that we've heard over the years was after a while, our biggest competitor became people like FTX. People said to us, our potential clients said, "Well, I'm only going to trade on one exchange. Why do we need software that's going to look at the prices on other exchanges and trade on multiple exchanges?" And they go, "We don't need that because this one will be fine." Well, that's probably not going to get said by a lot of people anymore. People now see the need to diversify their risk. People see the need to trade on one exchange, pull their coins off, and maybe trade on another one if, when they go to sell it or buy or do trades. So the truth of the matter is diversifying counterparty risk didn't even enter into the consciousness of most of the people in the crypto sphere until basically the last year when counterparties started to drop like flies. So that's been a big, big change, I would say, probably the biggest.
We can circle back to CoinRoutes definitely again, but let's just talk a little bit about 2022, definitely the year that we'd all like to forget, but definitely should remember. What would you say are some of the best lessons that we should have learned from this? So many things to list for the year. But what would you say is your positive from the amount of negatives that we saw in the year?
Well, the positives remain to be seen. People do need to learn, right? Look, I've written articles about this, and I break it down into a few things. The first thing really boils down to when people tell you something is too good to be true, it generally is. So when you hear that you can make 18% interest by depositing a stable coin into a DeFi protocol, and you're told that that's not going to take risk and you can make 18% at the same time that even treasury bills are paying, at that time they're paying like 2 or 3%, but it doesn't matter. But when you're making double-digit percentages for free, you should assume there's a risk to it. And it turned out that particular stablecoin, UST, was very risky because it was not really a stablecoin. It was an algorithmically backed coin that was aiming to peg to the US dollars, but the algorithm used other tokens, in this particular case, mostly something called Luna, in order to back that coin and keep it in a basic range. The problem with that is, as many people will tell you, is an algorithmic stablecoin that's backed on that. If you overwhelm the liquidity, which is shorthand for if you sell more than the treasury is able to buy, bad things happen. And in this case, and the story is still not told, we still don't know who or why sparked it, but we knew that there was a risk that the whole thing could be broken down like a house of cards. And the fact of the matter is, regardless of who did it, it did break down. And when it broke down, all those people who had staked that coin, meaning that they put it in a place where they couldn't touch it, couldn't sell, it went effectively to zero, and billions of dollars got lost. There were many, many firms that were doing this. And those firms, in many cases, were firms that were lending on behalf of clients who they thought were safe. And so the contagion started. So when Luna and Terra broke down, sure, a lot of firms lost money in the collapse of Luna, and some made money in the collapse of Luna, but more lost. A lot of people lost on the use of UST. And when the whole house of cards blew down, the knock-on effects were massive. So the first knock-on effect we saw with Voyager, and that's because a company called Three Arrows Capital was a big loser in this debacle, and ultimately they went bankrupt. And when they went bankrupt, their loans that they had taken out, because they didn't, they borrowed money in order to trade, couldn't get repaid. So it turned out a company called Voyager that people had put money in, thinking they would get a stable, I think in their case, 8% return, which still people should have questioned. All of a sudden their money got lost. Boom, gone. And it's in receivership. We don't know how many pennies on the dollar people are going to get back, but it won't be 100. And that was a big deal. More and more of those firms started to fail, culminating with Celsius, which failed over the summer. And so the second lesson is, if you, in addition to beware of people offering you something for free, is really make sure you understand what risks you're taking. Because if you look at the term of service for Celsius, it's a problem. And the way you know it's a problem is there was just a court ruling that said, based on the terms of service that Celsius made people sign, once you deposited Bitcoin on Celsius, you no longer owned that Bitcoin. You had an IOU from Celsius for the value of that Bitcoin. And that is a very big deal. So you need to understand what risks you're taking. If you deposit your coins on a platform, whether it be an exchange or a lender, make sure you know what you have title to and be very, very clear about the risks that those people are taking. And that's something that really wasn't understood before the year started. And the last piece of advice is one that I go something my father always used to say: never bet more than you can afford to lose. And that has to do in crypto in spades. There has been a history of people who would bet everything on leverage and get wiped out as a result. And a lot of the volatility in Bitcoin over the years has been because of so many people either going long or going short on leverage and getting completely wiped out when it moved too much for their position. The position was zeroed out and liquidated by whatever exchange. But the most ridiculous example of this was FTX. And it really wasn't FTX, it was Alameda, the hedge fund. And so somebody who's theoretically this leading light in crypto, betting more than he could afford to lose, happened. And then instead of closing down the hedge fund, he stole from customers to bet more to try to get it back. And then that got lost, and he borrowed more, and that got lost until he couldn't borrow anymore. And all of a sudden, they went insolvent. And so betting too much and not having risk control is the third big thing that people really, really need to learn.
For the end of 2022, we saw some, let's say, ridiculous rules possible from Elizabeth Warren, and then now we have the 1,400 pages from the SEC, kind of looking like they're almost trying to crush the whole industry. What do you think, if any of those laws or implications will be moved forward? And then what would you say would actually be some regulations that would be helpful to the industry versus destructive?
I mean, look, I don't know what will happen. I don't have my crystal ball. It's in the shop. But what I can say pretty clearly is that regulators who want power will always listen to Rahm Emanuel's advice: never let a good crisis go to waste. And so people will basically say lots of things because they're trying to kill their enemy. If you're Elizabeth Warren and you feel that keeping the banks in a cartel is good for your power base because it gives you something to campaign against, not to mention the fact she probably takes donations from them, but I don't know that in one way or another. The fact is, you're going to try to protect them, and the way to protect them is to stop disruptive innovation. Crypto is disruptive innovation in many cases. Distributed finance is certainly disruptive innovation, and to some degree, Bitcoin is disruptive innovation, although in Bitcoin's case, it goes deeper, because Bitcoin, if it continues to grow and becomes accepted as a global store of value, it starts to become an acid test of how fiscally irresponsible governments can be. So just like gold has performed that service over its lifetime, even though it's gotten less and less relevant lately, Bitcoin threatens the establishment in terms of creating a measuring stick that they don't want to necessarily see measured against. So it never surprises me when major entrenched regulators or banking captured regulatory agencies or people like the World Bank, for example, don't want to see Bitcoin or other aspects of crypto succeed, and so they will put out disruptive regulation. But the other thing that's interesting is even people that are opportunists will tend to pick on something that they don't understand. So, for example, this week, Letitia James, the AG of New York, put out a lawsuit against Alex Mashinsky of Celsius, and she announced it by a tweet or a bunch of tweets. And to be honest with you, I don't know the merits of the case, and to some degree I try not to, because Celsius was an investor in CoinRoutes, and so their estate has CoinRoutes stock, and before they blew up, they were a client of ours. So our only knowledge of Celsius was what they used us for, which was for doing a better job of trading on behalf of themselves and potentially for customers, although we don't even know if there are customers involved. But what her allegations are very serious, and they're very important. And I want to be really clear about this. The main goal of regulation should be to protect investors and facilitate capital formation and to maintain fair and orderly markets. Those are the goals of the SEC. In order to do that, one needs to promulgate principles that will work and should work with crypto. And I am all in favor of those, have been for a long time. I'm going to list 3 principles, and the first one is the one she was talking about. The first principle that Letitia James is talking about is something that is drilled into the head of everybody who runs a broker-dealer or anybody regulated by the SEC. I'm sure the same thing goes for asset managers as well, and that is no false or misleading solicitation. You were taught never use words like guaranteed returns. You were taught never tell people that you are less risky than something else. Always be specific about risk disclosures. Always be specific about how money is being earned, and do not use hyperbole. And her allegations, which are quite serious, are that Mr. Mashinsky promised people guaranteed rates of returns, claimed that Celsius was safer than banks, and things of that nature. The fact is, regulation that made crypto companies understand that they can't do false or misleading solicitation would be a good thing. Similarly, other principles that they should promulgate are no market manipulation, which sounds obvious. It means don't enter orders specifically to move the price of an asset. Enter them because you genuinely are trying, genuine bona fide buy or sell interest only. That sounds obvious, but maintaining the price of a token like FTT, for example, in order for collateral to look like it was more valuable than it was, is clearly market manipulation. And that sort of thing should be regulated against. Thirdly, and more broadly, provide for things like best execution or reasonable costs and everything being fully disclosed and risk disclosures. All of those things, which are generally part of the rule book for other investment and asset classes, should be in crypto. The problem we have is that the SEC has done the opposite. Instead of pushing for principles-based regulation, they have spent their time focused much more on enforcement against technical violations. Was this thing an unregistered security? I don't care if investors were hurt or not. Was it unregistered, yes or no? Was it a security, yes or no? That is not helpful. Doing regulation by enforcement has essentially disincentivized firms that want to be compliant from even participating in crypto. Broker-dealers generally don't participate in crypto. Even Robinhood set up crypto as a totally separate affiliate, not with their broker-dealer. So when you do that, you're creating what I call selection bias. You're telling people, you're making the industry worse by excluding effectively the people you want to be participating in industry. And the ones in the industry who are already there, who want to comply, have no way to do so. Because if they talk to the SEC, they'll be singled out. And sure, technical violations are really easy to prove. But when you're really trying to create rules that work with an industry, you won't get there unless you engage with the industry. And so that's what should happen.
As far as last year with the SBF scandal, you've talked about this a little bit on your videos for CoinRoutes, that the whole actual exchange, maybe it's an unpopular opinion, but an exchange platform that maybe has a split between the custodial and the actual platform. Do you think if that actually went forward, that could help with a lot of the issues that we saw in 2022 if that actually was implemented for 2023 through some of the exchanges?
As early as 2018, did a presentation to the SEC, and I did a presentation at a couple of conferences where I effectively said that one of the most important reasons for them to engage with the industry is to help work on crafting rules to manage conflicts of interest. Now, note I didn't say to stop conflicts of interest, because that's literally impossible. You are always going to have conflicts of interest in financial markets, whether if you're an exchange, even if you separated the custodial solution to another provider, you still are going to have some notion of custody, even if it's during the period of time that you're allowing people to trade in and out of a position. So there's always going to be conflicts of interest. So take a Coinbase or a Gemini. Both of them have affiliates that are custodial affiliates. I don't know if it's necessary for the custodial affiliate to be a totally separate company, but I do know that the custodial affiliate should be separated from the exchange and should be separated from the people who have incentives on the exchange to do bad things. So the example I gave in 2018, which is still true, by the way, but less bad than what Sam did, is if you have salespeople working for an exchange talking to institutional accounts, and they know that there's a big seller of whatever, of a coin, doesn't matter what the coin is, and that they know that big seller just dumped a ton of coins onto the exchange. Well, they're going to tell all their institutional customers, hey, I know this coin's going to probably drop because the people who have been the sellers are the ones who just deposited coins onto the exchange. Well, that is very different than people looking at the public blockchain and saying, someone just deposited coins onto the exchange. Because being able to know who was the seller, which the exchange knows, and which wallet is which, is a very important piece of information that if there were conflicts of interest were being managed, the people who knew who the sellers were wouldn't know the owners of various wallets. And so that's a pretty simple, easy example. That's just knowledge. But obviously, in the case of FTX, it got even worse. There, funds from customers were commingled with funds of risk-taking enterprises that were even owned by the exchange group in that particular case, that being Alameda. That's a real problem. Or if an exchange decided, for whatever reason, to suspend or change their risk products, their liquidation engines, their margin policies, with regard to a particular firm, whether they were an affiliate or simply someone giving them a kickback, it doesn't matter. You want all of those things to be surveilled. Do you want those things to have a compliance department looking at, to have policies to prevent them from happening, and a regulator who can make sure when they do audits that these things are being followed? There will always be mistakes, and there will always be people who try to push the rules, and that's true. But not having any regulation, not having any policies is a problem. And that's why I think that sort of separation that you mentioned is so vital. And yes, there are firms who are working to do this. And some of the best solutions are private market solutions. I don't want to name them, but I know of at least 2 custodial networks that are working with exchanges to be able to do third-party verification and to have networks of coins available for settlement. And those sorts of settlement systems will give people a lot more confidence. So it doesn't necessarily require regulation, although I think a lot of investors really would like to see that.
Is there any, at this point, checks and balances after last year to ensure that would not happen again this year as it stands right now? Or are we basically at the same place that this whole fiasco could happen again until things change?
Well, I mean, look, the market is terrified of that exact eventuality. And so over the last night, there were rumors running around about Huobi out in Asia. There's a run on Silvergate Bank, for Christ's sakes, in the United States going on over the last couple of days. So the answer is there's fear about it. But things are definitely moving in the correct direction. Now, is it moving in the correct direction enough? Well, time will tell that. But there are firms out there who are proving their reserves and sharing blockchain information. A lot of exchanges, most exchanges, keep the vast majority of the coins that are deposited in cold storage, which isn't attached to, which isn't as easy to prove, and in fact could create security risks if they did. But more and more exchanges are working with third-party providers. I guess I'll mention them, people like Copper, and soon, as I understand it, Fireblocks, with networks where you don't have to have as much physical movement, and those movements are more auditable. And so, yeah, I think that the market is definitely going to move in the direction of more certainty. It's also true that I don't believe anybody will ever be able to have a big risk-taking market maker that is owned and commingles accounts with customers of an exchange ever again. Now, does that mean that we know for sure that no exchanges have commingled accounts between non-disclosed affiliates and customers? No, we don't know it, but people are digging and doing much more diligence now and asking those questions and looking for audits. And that will eventually move the needle. My suspicion is that Alameda has always been kind of a special case, an extremely large visible market maker that theoretically we were told provided the profits to be able to build FTX in the first place. But the truth of the matter is I don't know of any other big market makers that are directly owned by an exchange group anymore. And so that is a big difference. We'll see how that boils down. That's not to say that there aren't exchanges with issues. There might be. But I don't know of any other exchange with a big risk-taking market maker that are directly tied to it. There could be other shoes to drop, but I suspect that we've seen the worst. Don't know that, and we'll never say that we've seen every big problem, though.
For investors that are maybe not as sophisticated in the crypto space, maybe they're only like trading through Coinbase or only on a couple exchanges or platforms, can you give them some ideas for best practices after last year? Like, do you recommend like cold storage? How many exchanges do you think that they should go through? Obviously, CoinRoutes would be fantastic as well, but anything else?
Yeah, it's important. CoinRoutes is just software. We're not an exchange. You can use us, and we're moving more and more towards retail. Right now, we're still for people who trade in the millions of dollars per month and more. For our platform, but we are definitely moving down towards the more casual trader by, within the next year. And people could sign up for that on our waiting list, www.coinroutes.com. If you say you trade less than $1 million a month, you will immediately go into our waiting list. And then when we have a retail product, you'll be out there. But the truth of the matter is my biggest advice, it's very reminiscent of what a lot of people in crypto say. They always say, not your keys, not your coins. I mean, it's not very hard to get a Ledger Nano or a Trezor or a hardware wallet and keep coins on those hardware wallets. It's not hard to put seed phrases in a different safe or safe deposit box than the actual physical device. The software is getting better and better. And so anybody who has any technology acumen whatsoever can certainly buy stuff on exchanges and then transfer it off onto your wallet and hold it. But if you're going to trade, if you're going to move assets around, if you want to have a general process, I would basically say diversify your risk and, have a couple of exchange accounts. And if you're going to trade more actively, then look to use software like ours or others to help you save money. But the truth of the matter is where it really gets to be important is if you're going to hire an investment manager and you're going to hire a crypto fund and you're going to give them money, ask the questions. Do you diversify your risk? Do you leave coins on exchanges? How do you handle and what's your approach to try to minimize those losses going forward? That's the really important part. It's really a question and answer for professionals to make sure they're doing things they didn't do before. And that's my most important advice, I think.
Some people that have said there's not real proof of concept for Bitcoin, and I loved your answer when I was talking to you last week. Can you give our listeners some example of the proof of concept for Bitcoin?
We'll start with, I will do that, but I want to make it really clear that the market and the price of Bitcoin clearly agrees with me. Bitcoin right now is trading at 4 times its bear market bottom from whether it's looking at the bear market of December 18, or the bear market that was the V-shaped bear market from the pandemic in March of 2020. It's 4 times that price. And it's been ridiculously stable at that price. It hasn't moved very much in the last 6 weeks ever since the FTX bankruptcy settled. So the market is sort of in an equilibrium where people see a value. And most of that value is not in the United States. Let's call it what it is. Over 30% of the people of the entire world live in countries with unstable currencies. So if you live in a place like Venezuela, where bolivars are actually more useful to use in creating baskets that you sell on the sidewalk, and by the way, there was a great news story about that, you can look it up, then for spending because of the hyperinflation rates, you need stable assets to be able to use that you could transfer. You need an asset that you can transfer that doesn't require you sewing gold or putting gold. Well, there was a story about people smuggling gold recently. That's really not, it's a little bit too gross for anything else. But let's just say that people have done crazy things. To bring out, Bitcoin is a lot easier to do that for. Bitcoin is almost impossible to counterfeit. Bitcoin's network is at an all-time high in its strength, the hash rate, which is why miners, by the way, are having a tough time. But the truth is the network is stronger than ever. Adoption is higher than ever. Innovations like what's going on with the Lightning Network, or with which is a big deal, and what Jack Mallers is trying to do in terms of payments, it's a big deal. Bitcoin's price volatility, as bad as people like to talk about it, is dramatically lower than a lot of these currencies. So for a lot of the people of the world, 30% of the planet, it's a better store of value even now than it's been. And now it's still speculative. It's nowhere near getting to where the digital gold, valuation would take it. And so that's why Bitcoin is a big deal. It's 14 years old. It has a clear network effect. It has at all-time high in its network stability and strength. And people think of it as the technology. I even saw a post reporter, Charlie Gasparino, saying, well, the technology's old. That may be the most ignorant statement the man has ever made. And he's actually a pretty good reporter, and he gets accused of a lot of things. But that one's unbelievably ignorant. It's not about the technology. It really isn't. It's about acceptance. And the question of, does the technology need to do more? And if you look at what Bitcoin is, it's incredibly hard to counterfeit. It has a monetary policy that is now only basically targeted at the Fed's inflation rate. And in less than 2 years, in the next halving, its inflation rate will be down to below 1% per year. And at those sorts of levels, it becomes a very reasonable chance to become a store of value. I personally look at it right now with incredible optimism. I look at it as it has never been clearer in my mind that it has a very real chance of achieving digital gold status, meaning accepted by a critical mass of people on the planet. Yet that would mean 20 times the price level that it is today. We more or less have to get to about $500,000 per Bitcoin to be the same market cap as what gold is. And even if you think that only 80% of gold's market cap is due to its use as a monetary metal, then that would still be a $400,000 price target for Bitcoin, which is more than 20 times where it is today. Yet, I would say that at no point in its history is it more likely to achieve that based upon adoption, hash rate, etc., and lack of need of rampant price speculation for that adoption to increase. So I'm quite bullish on it, long term.
Well, that's fantastic to hear. It's always good to hear the word optimism in this market right now. For a couple closing questions we usually ask, can you give us the story about your first client for CoinRoutes? It's usually always a good story with the first client.
Yeah, our first client and actually our largest outside investor is still Bitcoin Swiss. Bitcoin Swiss was a pioneer, one of the earliest Bitcoin companies out there. Certainly at one point was the largest crypto company in Switzerland. We met their CEO at the time, Nicholas Nicholson, in San Francisco, and he really liked what we were doing. He said he thought that it's really important for crypto to mature, and he still does as far as I know. He thinks that it's really important for people to be able to buy or sell more efficiently. And so Bitcoin Swiss decided that they wanted to use their technology because they could offer their clients better pricing for buying and selling, not just Bitcoin, but any crypto. Since he was going to use it as an integral part of their business, said, hey, I want to invest in you. And so we've been working with Bitcoin Swiss since, basically 2018, and they continue. But, they are one of the true pioneers in the space, definite what people will call OG in crypto. Although I don't like what OG stands for. Everyone knows what it actually means.
Oh, that's a prestigious first client. And for one of our other last questions, what's your favorite story so far that you've had in the crypto space?
I mean, favorite is a funny word. I mean, I think one of my favorite ones to tell, and it's not a nice story, is how which kind of points out the differences, which is I was sort of alluding to it before. In 2019, one of the things we invented a benchmark where people could see what the true real price to buy or sell any crypto would be. So we track right now in real time. We're tracking, what does it cost to buy or sell, for example, 5 Bitcoin. So right at this instant, if I wanted to buy 5 Bitcoin, I would pay, right now at this instant, I would pay to buy 5 Bitcoin, $16,906 and point blah, 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 blah. And that is taking fees and spread into account across all the major exchanges that trade Bitcoin dollar. And we also know what the cost to sell it is. The cost to sell it is $16,901. There's a spread of a few dollars. And that spread is as tight as it's ever been, maybe the tightest it's ever been. And that's based on institutional rates because costs have come down. Now, retail pays a lot more than that. It could be $30 or $40 more than that. And so we had a potential client we were talking to. We said, listen, we can give you this benchmark and we can help your clients trade at these tight spreads. And the person, who's very well known, he's a CEO of a major retail aggregator, said to me, Dave, are you effing kidding me? Why would I want to do that? Clients are willing to pay me $40, $50 more than that price, and I get to make some of it, and my market maker gets to make the rest. Why would I want to tell people that they could buy it cheaper? It's not a favorite story because it's really kind of gross, and it tells people what was wrong in the industry back then. The good news is I'm pretty sure that even though people are still paying that much, too much in retail to buy or sell Bitcoin, at least now they kind of know because they see the fees, and the fees are finally starting to come under pressure. And so the story of how fee compression happens is a big deal. Now, CoinRoutes, our software, helps our clients lower their fees. And the reason is because of the way that we actually execute. We turn their flow into what's called maker flow, placing passive orders, which get charged dramatically lower fees by most of the exchanges. And so we get to lower clients' costs. I really enjoy watching people's faces when they realize how much money they can save. One of our employees traded a bunch one month on Coinbase. I mean, a bunch, not institutional size. And he said, I can't believe I actually saved $4,000 in cost, almost half of the commissions he paid to Coinbase that month.
Wow.
Using CoinRoutes. And so when I say I want people to sign up for the waiting list, trust me, there's a reason. You could literally save, maybe 50% is high, but you could save a substantial amount of the fees that you pay exchanges by using our software. And so that's my favorite story to tell people because it's really about money. It's like we're trying to do things to help it get cheaper and better. But one of the best things about it is as markets get cheaper to use, as they become more efficient, guess what happens? People use it more and more. And so if what your goal, and one of my goals is to help adoption of Bitcoin, help adoption of DeFi and a lot of crypto use cases, smart contracts, et cetera, then making the market more efficient is probably one of the best ways I know of to help drive that. And so that's what we're really involved in.
Well, I imagine you'll have quite a big waiting list by the end of this year. And just to circle back to that, for anyone that's interested in joining your waiting list or checking out your platform, do you want to just give them the website and all your information again?
Yeah, it's www.coinroutes.com, CoinRoutes.com. Pretty easy to remember. And you click the sign up button. And if you're less than $1 million of trading a month, you go to the wait list. If you're more, one of our salespeople will call you for a demo. So that's pretty easy. You can also follow me at Dave Weisberger1 on Twitter or Dave Weisberger on LinkedIn. CoinRoutes itself is at CoinRoutes on Twitter and CoinRoutes on LinkedIn. And, we're posting content all the time. But most of everything we do post will also be on our website or through our mailing list if you sign up.
And for closing, do you have any words of wisdom or optimism for investors out there for 2023?
I would just say that it's very simple. There are thousands of incredibly talented people across the industry, whether it be Web3 for content, smart contracts of various sorts to disrupt a variety of verticals. I know of more people from traditional finance moving in to the industry in order to try to tokenize and make asset markets more efficient. When you see that many smart people moving into an industry, it's not dying. Regardless of the headlines in The Economist or what the FT will tell you, this is not a dying industry. It's an industry that's going through a down cycle. And historically, down cycles have been when the biggest fortunes have been built. And just remember that after the internet bubble crashed is when Facebook, Google, Twitter, and a variety of other companies all were being built. They were not the ones. Only Amazon went through the entire boom-bust cycle of the big boys. But it's just really important to understand, follow the intellect, follow the talent, and follow the money being invested, because while a lot of people aren't investing money writ large these days because of rates, money is still flowing into the sector.
Well, that's fantastic. Thank you so much, Dave. This was very informative, and I'm sure that the listeners will love this, and hopefully we can do a follow-up.
I would love to. Thank you very much, and thanks for having me.
That does it for today's Crypto Corner. If you would like to be a guest or sponsor for this podcast, contact InvestorIdeas.com. Investor Ideas reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. And this podcast is not an endorsement to buy products, services, or securities. Investors are reminded all investment involves risk and possible loss in investment. To hear more InvestorIdeas.com podcasts, please visit InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on Apple Podcasts, Audible, Spotify, TuneIn, Stitcher, Spreaker.com, iHeartRadio, Google Podcasts, and most audio platforms available. This podcast was sponsored by AppTech Payments Corp. AppTech is an innovative fintech company whose mission is to deliver a better way for businesses to provide their customers with immersive commerce experiences. For more information, visit apptechcorp.com. AppTech trades on the NASDAQ under the ticker symbol APCX.